Picture this. The Federal Reserve is carefully adjusting the dials of the economy, trying to tame inflation while keeping growth alive. Meanwhile, Wall Street's most festive tradition, the Santa Claus rally, has investors wondering, will the market deliver gifts or coal this holiday season? These two stories may seem separate, but they're deeply connected. Stick with me as we break down what's happening, explain why it matters to you, and uncover how you can take advantage of it all. Let's make sense of this holiday roller coaster. The Federal Reserve's slow and steady rate cuts, why they matter. Let's start with the Federal Reserve, often referred to as the Fed. Think of it as the ultimate financial referee. Its job is to keep inflation under control while making sure the economy doesn't fall into a recession. It does this by adjusting interest rates, which are essentially the cost of borrowing money. In 2025, the Fed has announced that it will cut interest rates, but here's the catch: it's doing so cautiously. That might sound like a boring headline, but it has massive implications for your wallet, your investments, and even the house you dream of buying. What are interest rates, and why do they matter? Let's break it down. Interest rates are like the price tag for borrowing money. When rates are high, your credit card debt grows faster because you're paying more in interest. Your mortgage or car loan becomes more expensive, meaning you might hold off on buying. For businesses, borrowing money to expand, hire, or invest in new projects becomes less attractive. But when rates are low, it's cheaper to borrow, so people and businesses spend more, fueling economic growth. Home buyers benefit because mortgage payments are lower. Companies can access funds to launch new projects, potentially creating jobs and innovations. Why is the Fed being so careful? The Fed's caution comes down to one word: balance. It's like walking a tightrope. On one side, you've got inflation, which makes everyday goods more expensive. On the other, you've got the risk of a recession, where spending slows, businesses shrink, and unemployment rises. Inflation has been cooling from its 2022-2023 highs, but it's still not at the Fed's comfort level of about 2%. That's why they're not slashing rates aggressively. They don't want to spark another round of price hikes. At the same time, they're aware that keeping rates too high for too long could choke off economic growth. How does this impact you directly? Let's get personal. If you have debt, high rates mean more of your monthly payments go toward interest rather than paying off the actual loan. This applies to everything from credit cards to student loans. 1. If you're saving, the silver lining is that savings accounts are offering some of the highest returns in years. If you've got cash sitting idle, this is a great time to park it in a high-yield savings account or a certificate of deposit, CD. 3. If you're investing, high rates often put pressure on growth stocks. Think tech companies with big ideas but not much cash flow. On the flip side, dividend-paying stocks and bonds become more attractive for their steady returns. The housing market, a game changer in the making. One of the biggest areas feeling the pinch of high rates is the housing market. Mortgage rates are hovering around 6 to 7%, which makes homeownership more expensive for first-time buyers. Let's put that into perspective. On a $300,000 mortgage, a 7% rate means paying nearly $750 more per month compared to a 3% rate. Over 30 years, that's an extra $270,000. But there's a silver lining here too. Developers are likely to shift focus toward affordable housing, which could bring innovative solutions like tiny homes, co-living spaces, or even 3D printed houses to the forefront. If you're waiting to buy, 2025 might bring some creative, cost-effective options. The Santa Claus rally, what is it? Now let's talk about the Santa Claus rally. No, it's not about elves trading stocks. This rally refers to the stock market's tendency to rise during the last week of December and the first 2 trading days of January. Historically, this happens about 75% of the time. Why does it happen? A mix of factors. Holiday cheer. People are generally more optimistic during the holidays. Year-end bonuses. Retail investors often use bonuses to invest. Portfolio adjustments. Fund managers reshuffle their investments to make their year-end reports look better. Will it happen this year? This year, the rally faces some serious challenges. Anonymous high rates. The Fed's cautious approach has made borrowing expensive, which could dampen spending and corporate profits. 2. Political uncertainty. With a new administration taking office, markets are jittery about potential tax and spending policies. And geopolitical risks. Global tensions always add an element of unpredictability. However, some sectors could still shine. For example, AI and green energy stocks might attract speculative interest, while defensive sectors like healthcare and utilities provide stability. Connecting the dots between rate cuts and the rally. Here's where it all ties together. The Fed's slow rate cuts directly impact the Santa Claus rally. High rates act like an anchor on the economy, making it harder for markets to climb. But if the Fed communicates its strategy clearly, showing that it's keeping the economy stable, it could inject confidence into the market, sparking a rally. And think of the Fed as the conductor of an orchestra, setting the tempo for the markets. If they get the rhythm right, the Santa Claus rally could deliver some much-needed holiday cheer. What can you do to stay ahead? Let's turn these insights into action. 1. Build a balanced portfolio. Diversify with bonds, dividend-paying stocks, and stable sectors like utilities. 2. Stay liquid. Keep cash handy to seize opportunities during market dips. And chase trends. Avoid making rash decisions based on short-term rallies. 4. Educate yourself. The more you understand about these events, the better equipped you'll be to make smart financial moves. Fun analogy. Santa's workshop meets the Fed. Imagine the economy as Santa's workshop. The Fed is Santa, adjusting the pace of toy production, money flow, to make sure the workshop runs smoothly. The Santa Claus rally is like the elves celebrating a job well done at year-end. But if Santa's too cautious, the elves might be less enthusiastic. Your role? Be the savvy observer, ready to grab the best toys when the timing is right. The Fed's rate decisions and the Santa Claus rally aren't just market events, they're signals of what's to come. By staying informed, diversifying your investments, and being proactive, you can turn uncertainty into opportunity. Do you think the Santa Claus rally will deliver this year, or will the Fed's cautious tone keep markets in check? Share your thoughts in the comments. And don't forget to like, subscribe, and hit that bell for more insights to help you navigate the financial world.